Cathie Wood just issued an urgent warning to all stock market investors. She says the bond market is now sending very clear signals to the Fed on what they should do next, and how the failure and subsequent bailout of regional banks like SVB marks the start of a new type of market. So if you have money invested in stocks, especially tech stocks like Tesla or Airbnb, this video is probably for you. In case you don't know who I am, my name is Alejandro and I build financial software for visualstocks.com. Now, Cathie starts by saying that US deposits, which mark most of the money supply, have been falling since August. And just now we're seeing the consequences of the yield curve inversion that we started seeing in July. Since then, this inversion has gotten worse. And all this means is that bond investors are telling the Fed that financial conditions are way too tight. Cathie continues pointing out that all banks got a lot of deposits from COVID stimulus in 2020, and these banks used that money to buy bonds at very low interest rates. But they never expected that fund rates would rise 19 times to almost 5% in less than a year. So now outflows are forcing them to sell these safe bonds to a market at huge losses. Because you gotta remember that bonds are safe as long as you hold them to maturity. If you have to sell them before that because say customers are withdrawing their money, you have to take huge losses, since bonds trade lower as interest rates go up. Cathie then points out that depositors are leaving bank because they can get higher yield on money market accounts. Like even Robinhood now offers 4.15% and SoFi offers 3.75% interest. And something similar happened to Silicon Valley Bank, where startups had to withdraw money to fund their operations because VC funding dried up. But this could happen to any bank if enough depositors withdraw their money. Now, Cathie says that since FDIC will bail out all the depositors but not the investors, this will cause investors to dump their shares on regional banks altogether. And this is exactly what we're seeing this morning. Cathie then warns investors that if the Fed continues to focus on lagging indicators such as CPI, the US banking will centralize and devour all the regional banks. And as a result, crypto will start going up, because it's not exposed to the same systemic dangers as the banking system is. I mean, that's the whole point of crypto. And of course, that's why we see Bitcoin and Ethereum blowing up this morning as well. But why does this matter for tech investors? Well, it's very simple. As Cathie puts it, the Fed always follows the bond market. And the bond market is now demanding that the Fed ease, and dramatically. And what happens if the Fed starts backtracking their tightening policy? Remember, the whole market started to crash because the Fed pushed interest rates way too high. If that trend reverses, we should see stock prices going up again, because the discount rate on DCF model starts going down, financial conditions ease up, and liquidity comes back to the market. Right now, why would anybody buy high growth stocks such as Tesla if they can get 4% on their money anywhere else risk-free? It doesn't matter how good Tesla's execution is, or how many strides they make. The stock price is just buyers and sellers. And in the short term, liquidity will drive stock prices, and in the long term, profits will. So watch for any signs of easing from the Fed, because this will push stocks higher. Now, I don't like focusing too much on the short term, because I believe in the long term, profits will drive value creation for investors. So if you're a Tesla investor and like more long-term fundamental research, here's a video for you, where JV Straubel, former CTO of Tesla and a co-founder with Elon Musk, has been able to solve one of the main scaling problems for EVs. If you're care about Tesla stock and the EV market, you're probably gonna find value in that video. So anyway, thank you very much for watching, and I'll see you next time.